All right, purchase method. This is important, obviously. You can find the greatest deal in the world. If you don't have any money to buy it, it's not going to do you any good. All right, so I'm not going to talk about, okay, you need to hit up your family, you need to do this, and OPM and all. I'm not going to tell you anything you've ever heard before, all right? I'm going to put out 4 things. My job tonight is to present you with options, and you decide what the best method is for you with your particular situation. And there's pros and cons to every different method. What I'm going to look at is, depending on the method, we're going to rate it. Is it consistent and is it reliable? Do you think that's important? Yeah. It's got to be consistent. It's got to be reliable. Will it help you get you there? Will it help you fulfill your goals? Will it allow you to get in and out of the deal? Because the way to make money flipping houses in real estate, you can make a ton of money in real estate holding rentals. That's not what this is about tonight. I'm talking specifically about flipping houses. You've got to be able to get in and out of these deals and turn them. And how much is the cost? Just because it might be higher interest rate, it doesn't matter necessarily. We've got one workshop that we do on just specifically on leverage where we show you how you can start with $15,000 and after 4 years end up with $350,000. And the whole time, most of the time you've done that, you'll have about $150,000 in your bank account. So you're never out a bunch of money. It's a neat workshop. And we compare that with somebody who starts out with like $100,000 in cash and just does all cash deals and doesn't use any type of leverage. It's a really fascinating workshop. Keep an eye out for it next year. All right, so let's look at these different ones. We're going to look at 5 different things that you can use to buy houses with. 1, cash or cash-like. So that would be like, cash-like would be like an equity line or something like that on your house, which a lot of investors use. It's a great option. So again, I'm not here to push one particular thing, even though I do own a hard money lending company, but we'll get to that later. But I'm just presenting you with these different options. You guys decide what's going to be best for your situation, because I have no idea what your particular situation is. So let's look at this. The cash reliable, will it help you get you there? Is it going to allow you to get in and out of the deal? Is the cost good? And are the cash on cash returns good? So at the bottom of the chart, you'll see this chart for each one of these. The bottom of the chart is not good. The top of the chart is good. Is your own cash, is that pretty, would you say it's pretty reliable? You got money in the bank, you know you can close, right? Okay, so reliability, we're hitting it out of the park on reliability, no problem. Is it going to get you there? Well, it depends on what your goal is. If your goal is to do one rehab at a time, meaning, okay, I got $100,000, so I'm going to buy a house, I'm going to fix it up, I got all my money out that I've allotted for real estate, all sitting in that house, and as soon as it sells, and as soon as the buyer's financing falls through again, and I sell it again, and then it closes, okay, now I can go and find another house. So the problem with the cash on cash, you can get in and out quickly once you get out. You can get back in. The cost is super good because it's cheap, right? But the cash on cash returns are tough because you're leveraging like 1-to-1. Bank rehab loans. You guys know what I'm talking about when we talk about bank rehab loans? Not many people have heard of them anymore. They used to be around all over the place. You couldn't swing a cat without hitting a bank rehab loan years ago. You could go to any bank, get a rehab loan to fix up a house. But now, because all the new regulations and everything, banks have really gotten out of that business. There's a handful of banks that still do it. I'm not going to tell you who they are, because this is being taped. But there's a handful of them, and they're okay. They're fine. Well, let's look at it. All right. They're pretty consistent, right? It's a bank. It's good. The money's there. They'll kind of get you there a little bit. But the in and the out, that's the thing with the banks. We sold a house. We used to sell a lot of houses to people that would use these rehab loans through banks. And there was a handful of banks still doing them. I think, like, when I say handful, I mean like 2, maybe 3. The problem is you still have to go through all the regulations and all the paperwork and all the red tape every single time you want to get another loan. The story that I'll tell you is this. We were selling a house to a guy, a very prominent local business owner who owns a very large fire and water restoration company. It's a family-owned business, very well-known company. They've got a lot of liquid assets. They've got the business. They're very successful, tons of experience in construction. Well, they didn't want to use their own cash, so they were getting a rehab loan from a bank over on the west side. They were completely approved, and then I go to the closing. I'm sitting in the closing for 2 hours. 2 hours over on the west side, waiting, because the one thing the underwriter was missing was the lease payment on their copier from like March of 2014, and they wouldn't close until they had that. And so we all sat there while they called the secretary, have him send that over. Again, it wasn't a good rate. The cost was low, right? There's a big advantage for the cost. It was like a low rate. But man, you're trying to get in and out. How can you build any momentum at all? And also, too, with the traditional bank financing, you've got credit checks, you've got debt to income. So you've got loans on your credit and then off your credit, then on your credit again, and then off your credit. And this one's on, but then it didn't get taken off. So when you try to buy another one, your credit still shows you got that other loan because it just paid off. So I get tired and worn out just thinking about it and just talking about it. But if you want to try to go that route, you can. Some investors will do that. The third thing is private money or partners. How many people have borrowed money from family members to start investing in real estate? By show of hands. Keep your hand up if you've had awkward Thanksgiving dinners when that deal you thought was a home run didn't go so well. I'm going to keep my hand up. If your father-in-law didn't like you before. So borrowing money from family members, from friends, it's awkward. It's very, very difficult, but you can do that. You can partner up with people. So let's look at that. It's kind of consistent and reliable. It depends on how well the last deal went, right? It'll definitely help you get there. It'll definitely help you get in and out. It's basically like cash, right? It's just somebody else's cash. It's hard to line it up, though. If you don't have a track record, see, that's a problem when you, just like anything else, right? When you need the money, you can't get it. But as soon as you're making it happen and rehabbing houses, it's really doing. You got people coming to you all over the place trying to give you money. Oh, yeah. Well, where were you 3 years ago when I didn't have two nickels to rub together trying to get my deal going? So that's the problem with that. The advantage of the cost is huge, low cost of capital. But so people that won't do hard money loans because they think that the interest rate's too high, but they'll partner with somebody and split the profit 50-50. Like, what? That doesn't make any sense. But we do see the situation if we've got like a money guy and a rehab guy. So one guy's doing the rehab, one guy's doing the money. In those situations, if you're the money person, most of the time, it should be 70% partner. Because if that deal goes south, they're not going after the guy that's doing the work, right? They're going after you. It's your dollars there. So if you are going to lend money to somebody to do that, I would push for 70% of the money, and they get 30% of the profit. So the cash-on-cash returns can be good because you basically don't have, the cash-on-cash returns are excellent because how much money do you have in the game? None, right? How much does your father-in-law have in? A lot, right? Okay, fourth is hard money. How many people have used hard money loans before? Handful. If you've not used a hard money loan, what are some of the reasons why not?
Expensive.
Expensive, what else? Anything else?
Carrying costs are too high.
So cost tends to be the pushback. Well, availability? Time constraints? Elaborate on that for me.
You need to sell your property that you use that money for pretty quick.
Right, because otherwise the carrying cost will eat you up.
Exactly.
It's a good point. A lot of reasons, too, that a lot of people don't use hard money lenders is that they're hard to find these days. You've got a lot of these national lenders that say, okay, we're going to be in 50 different markets. So they've got to be really careful with what they're going to lend on. They don't understand the local markets. We own a hard money lending company. And I know that a lot of the national hard money lenders don't do a ton of deals because I get calls probably weekly of a deal that was supposed to close with a hard money lender out of California. The guy's not going to do the deal because of the appraisal or whatever because he didn't know that this part of College Hill is different than that part of College Hill. Because on paper, this good part looks like the bad part. But they don't know that, no, that's a good part, right? So they don't do the deal. Then they call us. We close the deal. So the problem with the hard money lenders, yes, it's definitely it can be expensive, but the consistency and the reliability is a hard thing. You see all these advertisers on Facebook, and I'm not going to call them out specifically, I have before, that it just seems like a lot of times they take advantage of people. And it can help you get there. You can get in and out if you do it the right way and you plan it the right way. The cost isn't the greatest in the world. The cash-on-cash returns are fantastic. So I'm going to give you guys a fifth option. What if you could combine like the reliability of a bank, an institution, and have the good cash-on-cash returns? Well, we like to think of ours, and I'm not here to pitch our financing necessarily. I'm just here to tell you about it as an option. We like to think of ourselves as an institutional private lender. So we're backed by a major institution. So we've got access to the capital. We're not running around getting money, a little bit of money from here, a little bit of money from there, and then running out every couple weeks. Last month we originated 2.1 million in loans. The month before that we originated over 2 million in loans. This month will be at like 1.7 million in loans. So we originate a lot of loans. And we're local. So we understand the market. We can close a loan as little as 5 days. The advantage of ours is this. There's a trade-off. Hard money's expensive, right? Well, here's what we try to do. Yes, it can be expensive, but we require no personal guarantee, no credit check. So a lot of other lenders, they say, okay, well, yeah, we'll do this, and we'll give you this, but the loan to value is really low. They'll do like 50% or 60%. We'll do 75%. And then sometimes they tell you there's no catches. And then the day before closing, oh yeah, you've got these other properties. We're going to put junior liens on all those other houses you have. And well, this one too, that's the house I live in. Yeah, we're going to put a junior lien on that one too. So they want a lot of skin. So when we started ours, they said, okay, well, there's got to be a trade-off. If we're going to charge an interest rate that's a little bit higher, we at least want to make sure that there's no personal guarantee, so it doesn't affect your credit score. It's a truly private loan. You can close in 5 days, and we'll go up to 75% loan to value. So if you want to learn more about that, I'm not here to pitch it. I'm just here to tell you about it. But afterwards, we are doing a financing presentation, and I will warn you, every single one of these financing presentations that we've done, we've been doing them for about 6 months now, at least one person who sat in that room has bought a house within the next 30 days. So careful, if you go to that presentation, you may end up buying a house. So I'm just going to warn you, all right? Because at least one person has every single time. But they'll explain to you, if nothing else, you get to hang out with Rachel and April for 30 minutes, which is never horrible. So they'll explain how it works, and they'll explain how you can leverage it and show you that, yeah, it might be a little more expensive, but the cash-on-cash returns makes it very, very attractive. Yes, Mike, you had a question?
Just a quick question.
Sure.
On the loans, I know you said they would cover it there, but do they actually the company you're with, do they actually transfer the property and put a lien on the property? Or are you just a rehab guy for the property, and when it's all done, you get the property?
No, it works just like a normal loan, where we secure the loan with the house itself, just not with any of your other properties. So if you own like rental properties or like your personal residence, you're not securing it with any of your other assets.
You're closing, the deed is actually transferred over, and then they become a lien holder.
Correct. Correct. Yes. It's just that we don't. There's no other backing. You're not guaranteeing bank accounts. Your only collateral is your interest in that particular property. Yes.
Draw schedule?
What's that?
Draw schedule?
Draw schedules for ours. You get as many draws as you want. They're $150 a piece, so we try to limit it to 2 or 3. But we don't deal with the percentages. Okay, I'm this percentage done. We do a specific breakdown that you work with the inspector, and Andy does a lot of the draw inspections. Specific breakdown where you say, look, these are all the things that I'm going to do, and they're specific items, and this is what we think they're going to cost. So when you complete that item, that you can see right there, okay, that's how much I'm going to get. So it's never my 20% complete and your 20% complete is probably different, right?
I'll give you a little plug. That's a blessing.
Well, thanks. We've been there. Like, we've all invested in real estate. I was a borrower. I was a loan officer for hard money lending company. I've been on all sides of this. So we try to make it as easy as possible. For example, when we release the draws, we release them Thursday night, so it hits your bank account on Friday, because you guys want to get paid, right? There's nothing worse than a bunch of angry rednecks banging on your door wanting to get paid. Well, my draw's coming. They don't care.
Do you only do it in Cincinnati, or is it Columbus good? Or?
Cincinnati, Columbus, Dayton, and Northern Kentucky.
Now, is the loan on the property including the rehab? In other words, you don't get the rehab right away, but the interest is, let's say the house is $200,000 with $100,000 worth of rehab. The loan is from day one on $300,000 with the interest. even though you don't get the other 100,000 until gradually you finish the rehab.
Right. So the question that he has is this, we get this a lot. It's basically, it boils down to this. Are you paying interest on the rehab money that's sitting in escrow? Right. Yes. You're paying on the full loan amount. It's just easier for a multitude of reasons. So all the more reason to try to get that rehab done. So it doesn't work like an equity line or anything where it fluctuates. Yeah. So, any other questions about that? Cool. All right. Of course, since I'm talking about my own company, I'm going to tell you that it's all 10s on all categories, right? It's consistent, it's reliable, we can close, we're backed by a large institution. We can absolutely help you get you there. We'll work with you, we'll help you do multiple deals at a time, we'll help you carry multiple loans at a time, structure in a way that you're not going to get yourself in too much trouble. And sometimes you will thank us for not letting you do a loan because we're going to save you from yourself. So we've got skin in the game as well. We want to make sure that you're successful. So we'll help you get in and out. You can turn these things quick. We're a lot of investors that they know, okay, I've got 2, I think we just sold one the other day, where they know they've got 2 closings coming up in a couple weeks. They want to know, can they do another loan? Yeah, let's go ahead and get that going now. So when those close, you can start your next one. So we've already got all their paperwork. It's a 1-page online application. No personal financial statements or nothing. It's really, really, really easy. The cost, it is a little expensive, but it's right in line with what other hard money lender companies charge. But the cash on cash returns are just absolutely out of this world. Out of this world. Your cash on cash returns, and you'll see on all of our packets, the cash on cash return if you use our hard money lending. You may have your out of pocket maybe $10,000 or $12,000, but you may make $20,000 or $30,000 on the deal. So that's a pretty good return, right? Yeah.
When you have an extra amount of after repair, to be financed, then at the end of the rehab, you need 15,000, let's say 15,000, because some of the rehab haven't been finished. How do you negotiate that? Is that some kind of percentage that you allow of?
Usually we'll make sure, because we sat down, most of the times it lines up pretty well, because we sat down with you and said, okay, how do we want to allocate this? So when you get to the end, you're usually done, and you've got all your money. But if you get it done for less, that's your money, so it's fine, yeah. Yeah, we don't look at receipts or do lien waivers or anything like that. Again, if we're going to charge you a higher interest rate, we want to try to at least make it as easy as we possibly can. So I always say we're never the cheapest, but we're absolutely the easiest you will ever deal with.